day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on understanding exchange-traded funds, ETFs. What are ETFs? Exchange-traded funds are baskets of securities like stocks, bonds, and commodities that can be bought or sold on an exchange. For instance, an equity or stock ETF is set up to track a certain number of stocks, which implies that the performances of these stocks will determine the performance of the ETF. However, ETFs are less volatile because the companies in the basket have different levels of risk and other idiosyncratic factors. ETFs are professionally managed like mutual funds. Difference between mutual funds and ETF. Mutual funds are structured in a similar way to ETFs. However, one of the main differences is that ETFs can be traded at different prices on the stock market, while mutual funds are traded at a single price at the end of each workday. Due to its passive nature, ETFs charge lower fees compared to mutual funds, which usually require the fund managers to be active. Active fund managers rarely outperform passive fund managers, tracking the broad market over time. Another important difference is that ETFs can be bought through a stock trading app, but you have to reach out or utilize the platform of the fund manager to invest in mutual funds. Types of ETFs. The underlying assets, that is, the asset the ETF tracks, are what differentiate ETFs. 1. Equity ETFs. This tracks a basket of stocks, thus providing you with an avenue to invest in the stock market. Equity ETFs save you time and do not need to be an investment expert or know how to pick stocks to invest in them. The equity ETFs can also be sector focused. For instance, an ETF can focus on the technology or financial services sector. The performance of the sector will also determine the performance of the ETF. 2. Fixed income ETFs. This majorly tracks bonds such as corporate or government bonds in different currencies. Notably, bond ETFs tend to provide a steady return at potentially lower risk than equity ETFs. 3. Commodity ETFs. This provides an opportunity to invest in commodities like gold, silver, and oil. Commodity ETFs provide a safety net in the event of a stock market downturn. Also, owning shares in a commodity ETF is less expensive than owning the commodity itself. 4. Currency ETFs are used to speculate on the prices of currencies based on the political and economic development of a country. They are also used to diversify a portfolio or hedge against volatility in forex markets by importers and exporters. How do ETFs work? 1. The fund manager considers the universe of assets, including stocks, bonds, commodities, or currencies, and creates a basket of them with a unique ticker. 2. Investors can buy a share of that basket, just like buying shares of a company. 3. Buyers and sellers trade the ETF throughout the day on an exchange, much like a stock. Next week, we shall consider the advantages of investing in ETFs, the platforms to access ETFs, the criteria to consider when selecting ETFs, the popular ETFs in the US with the average return for 5 years, as well as the popular ETFs in Nigeria. Thank you for listening. Please join us same time next week for another exciting and interesting session. For questions, comments, and feedback, kindly forward to info@getfinanceandinvestmenttips.com or send SMS to 070-8246-3747. Stay blessed.